Hi everyone, and welcome to the solution to problem number 2 for learning objective 1-8 here in module 1. In this problem, we are looking at potential impairment of goodwill. So if you remember, goodwill represents the difference between the purchase price. Now, the definition is more technical than just purchase price. It's actually referred to as the fair value of the consideration given. But let's just say it's the purchase price for, conceptual purposes, just for discussion purposes. Goodwill is equal to the purchase price in a merger and acquisition transaction. And we're going to compare that to the fair value of the net assets acquired. All right, so what we're really saying is, what did one company pay to buy another company? Right, so let's say in 2014, Apple, right, we have Apple buys Beats Music, right? That company founded by Dr. Dre and Jimmy Iovine, and they buy Beats Music. So Apple buys Beats Music, and what we're saying here is that I believe the amount was, and I'm just throwing hypotheticals out here, but I think I'm pretty close. I think the purchase price was Apple paid $2.6 billion. Oh my gosh, imagine that. You're the owner of Beats. So Apple buys Beats Music for $2.6 billion. And at the time, I think if you looked at Beats' balance sheet, their assets minus their liabilities, their net assets, were $0.4 million. So this was the fair value of net assets. All right. So why did Apple pay $2.6 billion for Beats' balance, or for Beats, when the Beats' balance sheet suggested it was only worth $0.4 million? Well, it's really it's a premium. They paid a premium, and there's all kinds of reasons they paid a premium of $2.2 billion. There's all kinds of reasons for why they might have paid $2.2 billion. And what goodwill represents, this is recorded as goodwill in the financial statements, but it represents like the value that Beats has that was not captured in its balance sheet, right? So it's like this unrecorded value. Relates to many different things that we can't put our finger on. Maybe it's Apple thinks that Apple wants to get into the streaming music business, and by buying Beats, they take Beats out of the market as a competitor. And how do you that's not something that would be reflected in Beats' balance sheet, but nonetheless it has value to Apple. Okay, so what we're talking about here is goodwill, right? So Apple is buying Beats. They're paying $2.6 billion. Beats is worth 0.4. So therefore, that extra amount that's paid by Apple, the premium, in accounting, we're going to call that goodwill. All right. Now, goodwill is an indefinite life intangible asset, which means we don't amortize it. We do not amortize, or if you're more familiar with depreciation, right? If you have a property, plant, and equipment asset, you use the vehicle or the building a little bit each period, and so therefore its value goes down a little bit each period, and that decline in value we call depreciation. Well, when we're talking about intangible assets, we call that depreciation amortization, okay? Well, what we're saying here is goodwill does not depreciate, it does not amortize. Instead, what we do with the goodwill is we test it for impairment, and we're required to test it for impairment on an annual basis. So on an annual basis, we test for impairment. Now, do you remember how we tested finite life assets for impairment in the other exercise that we did? Well, we did a two-step test, and we said, basically what we said is, what's the value of those finite life assets in the balance sheet, and let's compare that to like the real world value. And this real world value, we represented this with, in step 1, undiscounted cash flows. In step 2, we use this other measure called fair value. And these are all, they're surrogates, they're stand-ins, they're substitutes for, this real world value. So we used fair value also, okay, right? And so we said, what is the balance sheet value for this asset? And let's compare that to its real world value, which we're going to represent with undiscounted cash flows or fair value, right? And if this real world value is less than what's in the balance sheet, then we're going to record an impairment, because the real world is telling us, hey, your balance sheet has this number way too high. That was the idea, right? That was the intuition. Well, how do we do that with goodwill? I mean, we don't even know what goodwill is, right? It's all we know is it's the premium that Apple paid for Beats, for example. Well, what's the real world value of that? What's the real world value of that asset, the $2.2 billion premium? Well, we don't even know what that premium was for exactly. I mean, we have some vague ideas, but if we had a concrete idea of what that premium was for, we would have recorded a separate asset for it. Goodwill is just, it's the leftover. It's the amount that's left over from the transaction price. So how do we test it for impairment when we don't even know what type of asset it is, and we don't know, and if we don't know what type of asset it is, there's no way that we're going to be able to approximate its real world value. So what GAAP says to do in this situation is, let's take, what we can do is we can come up with a substitute we can create a test that substitutes for the test of goodwill. All right, and the idea here is that companies are composed, so we have an overall company, right? We call this a consolidated entity in accounting, but let's just say it's like the overall company, right? And then within the company, you might have heard of this before, but there's like these things called subsidiaries, right? And these subsidiaries are like, for example, the overall company might be Apple, and after they acquired Beats, one of the subsidiaries might be Beats. And these little boxes underneath, we call them subsidiaries. All right, so they're part of the larger company. They're subunits of the larger company. Oh, I did not like that line. All right, let's draw this again. Okay. All right, it's a little better. Sorry for the crude drawing here, but so we have a sub here, subsidiary, sub. All right. Now, what the goodwill impairment test says is, let's think about these subsidiaries. Let's go one level up. So maybe like subs 1 and 2 are part of what we call a reporting unit. So let's say we're going to test a reporting unit for whether or not its value has declined. So instead of saying the subsidiary level, let's use what we call the reporting unit level, which is it's a technical accounting definition of what a reporting unit is, but it's the idea here is it's similar to the subsidiary. What we're trying to represent is a smaller piece of the company. Multiple reporting units make up the overall company, but it's analogous to, for your purposes, it's analogous to a subsidiary. GAAP refers to them as reporting units. All right, so we have various reporting units, and these reporting units have their own assets, their own liabilities, their own income statement. And what GAAP says is when you buy a company and you have goodwill, what you have to do in that acquisition is you need to allocate that goodwill to a reporting unit. So you need to basically decide which of your smaller pieces of the company will house this goodwill. And so I highlighted in yellow this reporting unit here. This is where we're going to put the goodwill, okay? And since the goodwill is in this reporting unit, we can indirectly test goodwill for impairment by saying, well, how does the reporting unit's fair value of net assets compare to the reporting unit's book value, okay? So we're going to say, what's the fair value of the reporting unit's net assets compared to the book value of the reporting unit's net assets? And that will stand in for goodwill as our test, okay? So we're going to say, let's take the fair value of the reporting unit which in this case is $260 million. They tell us this here, fair value of Oxford, which is the reporting unit, is $260 million. Let's compare that to the book value of the reporting unit, including goodwill. Book value of reporting unit, including goodwill, which is 234.5. And because the fair value, which is like meant to represent the real world value, because the 260 is larger than the 234.5, because the real world value is bigger than what we have in the balance sheet, we have no issues. And the solution here is that there is no impairment. We do not have an impairment of goodwill here. Now, if these numbers were reversed, if the fair value of the reporting unit was 234.5 and the book value was 260, then that would be a different story. Then we would have an indication that the fair value, the real world value, is different than what we have in the balance sheet, and we would record an impairment. All right, so a lot of explanation here, not much in terms of calculations or journal entries or anything like that. But I wanted to give a thorough explanation, which I'm hoping helps you understand what we're doing with goodwill test. Overall, I think what I want you to take away from this is if we have a regular finite life asset, our impairment test is basically saying, like, what's the real value? Like, all right, well, we got these GAAP rules, right? But there's also a real world value as well. So what's the real value versus the book value, which is based on GAAP? And that's what we're doing in the finite life test. In the goodwill test, the indefinite life test, we want to do the same thing. We're trying to do the same thing, but we don't know. There's no way for us to know what the real value is. It's not like you could go to the Goodwill market and buy and sell Goodwill. There's really no way of approximating that. And so what we do is we, the reporting unit fair value substitutes for Goodwill fair value. And we compare that to reporting unit book value. That's the takeaway here, right? And so it might seem confusing, like what is a reporting unit? Why are we using it? Why aren't we testing Goodwill directly? And that's the reason, because we cannot do that test because there is no real world value on Goodwill. It sounds funny as I say that, right? Because I'm an accountant, but Goodwill is a fake asset. It does not exist. It exists only because our balance sheet does not effectively capture the real world values of all assets and liabilities. That's the only reason it exists, and this is the way we test it. All right, well, I hope that you found this video helpful. Thank you for watching, and I'll talk to you real soon. Take care.